So I just had a really good question from a client that I thought was worth going over in a standalone video instead of just on our weekly Q. And it has to do with cost segregation. The question was, where does it go on the tax returns? And the answer is nowhere. But I'll get into the details here a little bit. So, what is cost segregation? Cost segregation is the practice of taking a real asset like a house and segregating its different components into all of the different categories that it should go into for depreciable life. Now, depreciable life is a lifetime that is determined by the government and applied to a category of thing. So for residential real estate, that is 27 and a half years. So you take the value of a residential real estate property and you divide it by 27.5, and that's the depreciation expense you're allowed to claim every year. So that's roughly 4%. In a normal situation, before cost segregation, you have some kind of real estate asset. You have some land value is not deductible at all. And then you have the improvement value on top of it. And that's written off at about 4% a year. And you get a depreciation expense. And so that goes on to typically it's going to be your Schedule E, which is where rental property goes on your personal tax return. And then you're going to have other things on your tax return, your W-2s and whatever. So for the high income earner, is this useful? And the answer is maybe. Depends, like I always say. So what does it depend on? It depends on the amount of other income you have. If you're over 150,000, and that's from all sources, then the passive limits get suspended. And what that means is that if you have a loss from a real estate property on your Schedule E, it does not count in the current year. That loss carries forward into the future, either until your income is below that 150 and you're able to start to claim it, or until you sell the property, at which point all those losses will be taken at that point and it will reduce your ending gain. So you don't lose it, but you may not be able to use it currently. So if you're over the 150, then the cost segregation may be useful if you're able to get that out of the passive category. And there's a couple different ways to do that. So one is to do short-term rentals. If your average stay is under 7 days for tenants, for occupants, whatever you want to call them, then you are no longer in the rental business. You are in the hospitality business, and that becomes active by default. On the other hand, there are other tests that you as the owner can satisfy in order to become materially participating. And so some of those tests are the 100-hour test, where if you spend at least 100 hours involved in the real estate and you are the individual who spends the most time on that property, then that counts as materially participating. If you cannot satisfy the 100-hour and the spending the most time, which a lot of owners, like we had one owner who spent 70 grand on renovations in the past year. Now, that's a huge deduction, but that means that 100-hour test is out the window because the guys who were doing the work there spent more time in the time took to fix all that up. So 100 hours plus being the single individual who spends the most time, or 500 hours, or 750 amongst all real estate activities and 50% of your time amongst real estate activities. So people get confused by the 750 versus 500-hour test. So the 750 test is to be real estate professional. And this means that you are spending at least 750 hours during the year and at least 50% of your working time is devoted to real estate activities. Now, the advantage of this classification is that it doesn't have to be related to that property. So you could be a realtor showing other people houses for sale. You could be a property manager. You could be in construction. You could be in a lot of other things related to real estate, as long as you're working on your own behalf as either an independent business owner or a contractor or something like that. Then all of those contribute towards that 750 hours. If you're on the 500-hour test, we're just dealing with the properties themselves, and you can't pull in realtor activities that are unrelated to the properties. So that's where the subtleties come in. And there's a couple other tests, but those are the primary ones that we end up dealing with over and over again. So if you're able to satisfy one of those tests, then that shifts that Schedule E from being passive and limited to being active and unlimited. And that is a critical distinction. If you're able to make that situation work, then you do the cost segregation study, which is hiring a firm to examine your property. If it's under certain limits, then there are online tools you can use, but otherwise you have to hire an actual engineering team to come out to the property and examine it, and they'll give you a report. And what that report does is it breaks down your property into all its different categories. And so it's going to break it down into 27.5 year property. It's going to break it down to 5 year property. And I don't think I've never seen a cost seg report that had 3 year property, but I guess theoretically it could happen. So then you take all that and then you change the depreciation schedule on the tax return itself. And that's going to boost your depreciation expense going through your Schedule E much higher, which drives the income down and usually will generate a much bigger loss against your other income. I know that was a lot of words, and I'm going to show you exactly how it works here on an actual tax return. So this is Taxpayer Jones. I'll switch my browser here. So here you can see Taxpayer Jones, and Taxpayer Jones owns 123 Main Street, and the rent is $15,000 for the year. And there's some insurance expense, there's some management fees, there's mortgage interest, taxes, and depreciation of $10,000, 10,107, which creates a net loss of $7,607. But because our income is 200,000 here, that loss, which would show up right down here, is zero. So this is the passive version where the expenses get suspended. And if you want to dive into the details, that goes on Form 8582, passive activity loss limitations. Unallowed loss, 7,600. So that number is going to carry forward if we don't do anything. Now, let's say we talk to Taxpayer Jones here. He actually spends a lot of time on the property. He is the person who spends the most time as an individual. And so he satisfies that 100-hour test. Okay, great. So now we go back to the tax return itself and we mark it as non-passive. So I'll show you how that changes things here in just and do that. I know you can't see it, but just take my word for it. So now we refresh and now it's a non-passive loss. Okay, great. So we're getting $7,607 of deduction from that active participation, and that lowers taxable income and that lowers the tax. Great. Now what happens when we do cost seg? So the thing to watch is on Schedule E, line 18, right there, depreciation expense or depletion. Depletion is for like oil wells and stuff, but depreciation expense. 10,107, that's our starting number. So now I'm going to go into the depreciation schedule. And obviously these are all just made up numbers, but let's go here. There we go. Okay. So the way I had set this up was this was a $300,000 property bought in 1/1/2023. It was 10,000 land and 290,000 27.5 year property. So now let's say instead of 290,000, we get, I don't know, pick a number. Oftentimes we'll see 15% ish of the improvement value being segregated into those shorter term categories. So let's say we get 40,000 of the 290 recategorized, segregated into different things. So we'll call this 5 year property and we'll call it 15 year property. I'm going to skip the sevens just because. And this goes on Schedule E. This goes to our rental property. This is furniture and fixtures, and this is improvements, all the same dates. And we're going to put 20,000 in each, which means the basis of the improvements go down by $40,000. Got to make sure we reconcile that. Now, this does lower your tax basis when you go to sell. So that's something to keep in mind. Let's see, this is 5 year rental stuff, and this is 15 year improvements. Okay. So now when we go to our depreciation, let's go back there, switching those. Okay. So now we were at 10,107, which brought our income from 200 down to 192. Then I'm going to refresh so we can see the difference. So now we're down here at negative 39. So we went from -7 to negative 39 because of the reclassification of those expenses or of those assets. That now we're able to take a stronger depreciation in the early years at the expense of not taking it in the later years. So there's no free lunch. You take it up front so that you can't take it later on, but it's worth it because time value of money dictates that money now is worth a lot more than money 27.5 years from now. So now our $200,000 W-2 was reduced by 39,000 and taxes are about $8,000 lower. So by reclassifying that with this particular taxpayer situation, then we're able to capture an additional $8,000 of tax savings by doing a cost segregation on property. Now, as you saw, there's a lot of ifs and there's a lot of conditionality that goes into that whole analysis because it's not for everybody. I have seen people come to me with a cost segregation report And they say, here, isn't this great? I said, don't do anything for you because it doesn't apply to your situation. Either you didn't have a tax liability or you can't satisfy your own participation test and you don't have the other income in the rental to absorb it. Got to make sure that these things make sense before you dive into them. But if they do, it is a powerful tool. So if you are a real estate investor and this is the kind of thing that you have questions about, come on by our Q&As. We do them every week, Tuesdays, 6 p.m. But also, if you want to just talk to us, go to taxsherpa.com. You can book a consultation and we will go over your individual situation and figure out if these kinds of things do apply to you. All right. We'll see you on the other side.